as we look at the numbers from February, I don't see any evidence of a housing market crash. And so let's start off talking about mortgage interest rates. Those started to climb a little bit. So walk us through where rates were, maybe January, now getting into February, and then, or getting into March, I should say, because we're looking at the February numbers, and tell us kind of why rates are on the rise.
So really they're still historically low, right? Mm-hmm. So rates are really, really low. And in January, there's a lot of uncertainty because we were really still very much shut down, right? Yeah. So we were writing loans. I'm writing a lot of, like, if you're looking at a 30-year fixed loan for your really good credit, 5 to 10% down in a lot of those cases. We're doing loans at like 2.75%, right? On a 30-year fix, which is pretty good.
This was going into February, correct?
Going into February.
Yeah,
yep.
Got it. Okay.
And then we saw, so a couple things happened in February. Middle and late February, we saw private payroll, like people's unemployment claims dropped. And they were kind of like, whoa, why is that dropping? And the Fed while the Fed said, we're going to continue to accommodate the American economy by continuing with their aggressive monetary policy, they call it, right? So they're buying bonds and buying mortgage-backed securities.
Yeah.
Really driving these rates down. They said, we're going to do this until, I think they wanted employment to be at 4% or less and inflation to hit 2% and really stay there, right? So have this stable, that's considered the stability that they want, like their stability benchmark where they'll start easing monetary policy, meaning they'll stop buying some of those mortgage-backed securities and start raising some of the rates. So what happened is these unemployment numbers where people were looking at were the amount of times people claimed unemployment, right? The people losing jobs, right? So unemployment claims went way down in February, and they're like, oh my God, what's going on? And the Fed never came out and said, like, hey, remember, we're going to keep it cool. Like the Fed just did nothing, right? Like the total Fed thing, they're like, we're just going to confuse everybody.
Right.
Rates flew up in the month of February. I mean, really, within a day, we lost about a point in interest rates. So rates went from like 2.75 to like 3 3/8, 3.5%, literally in a day.
Wow.
And then we got a lot of that back on Friday. Markets settled down and things kind of kept settling down. Competition built back up between mortgage lenders. And we ended up, even in today, like today I wrote a loan this morning. Today's the March 9th, right? So I did a loan this morning at 2.99%.
On a 30-year.
On a 30-year fix. So rates up a quarter.
Yeah.
At the end of the day.
Okay. So the important thing I think for people to understand is that, as the economy, as information about the economy comes out that potentially strengthens the economy, like an unemployment rate gets better, mortgage interest rates tend to get worse. Conceptually, Can you walk us through why that is? Because that's the key takeaway.
Yeah, positivity is bad guy vibes in the morguage world, right?
Sure, yeah.
So that's like when we start seeing good things happen, we're like, here we go,
Yeah.
So the reason is so like a mortgage-backed security or a 10-year treasury, which is like a long-term, low-yield investment, right?
Yeah.
So those are not considered risky investments. They also don't pay out a huge amount, right? So it's just a good place to park your money. And when the economy's doing well and we're getting a lot of good news, they say people are going back to work, people are happy, people are confident, they're going to go to the movies, they're going to book vacations, they're going to buy expensive tennis shoes and all these things. So now you're like, okay, well, I'm going to buy that, the stock for the company that owns Imagine, or I'm going to buy, 7 brand jeans. Like people are going to buy $200 jeans again.
Sure.
Because they know they're going to go back to work. So
okay.
All these people that park their money over here in Safetown that the government's kind of providing the liquidity for so they can buy and sell these bonds and
which is the bond market.
Yeah, exactly. Yeah. So they have these safe investments. They're like, well, wait a minute, everybody's getting in a good mood. Let's jump on this train and let's pull our market out of here.
Got it.
So in order for people to be comfortable investing in these bonds, what they have to do is they have to raise their yield, right? They have to raise the rate of return by raising interest rates. So that way there is people that are willing to sell these bonds or buy them. So it's providing liquidity, right? Keeps the market moving when everybody else is moving over here to the vacation and tennis shoe.
Got it. That's a great explanation. I love that.
Does that make sense?
It makes a lot of sense.
Okay.
And so the key thing, as we're talking about the mortgage market, and then we'll go to the housing market in just a second, is there were, and we ended 2020, there were about 3 million mortgage delinquencies.
Right.
That's down as of late. At the end of February, the report came out. It's only about 2 million.
Yeah.
So 1 million people got essentially up to speed with their mortgages.
Yeah. Yep.
And so any information on any more of the delinquencies because that was the big thing, right? Because people that are claiming this housing crisis, another housing crisis is coming, we're betting on the fact, Steve, that we're going to see this huge foreclosure market hit late 2021 because listen, there's 3 million people late on their mortgages. Well, now there's only 2 million.
Right.
All right. And so you called it an artificial mortgage delinquent market.
Yeah.
So what information do you have on that?
So I don't have specific stats on it other than that within that the like conventional lending, right, which is going to be your your good credit. It doesn't have to be perfect, but just your conventional non-government loans, right? It's not a FHA or a VA, USDA in that part of it too. Conventional loans are doing great. People are coming out of forbearance because you have to think a lot of these mortgage delinquencies, a lot of the people that did forbearance, and I see it a lot in credit reports that I pull, these people just wanted a break. Mm-hmm. Like they're still working. Maybe, one of the people in the household got laid off.
Yep.
And now they're like, Steve, I want to refinance, but I did that forbearance. Like, what do I have to do? I'm like, well, you have to get out your checkbook and you have to write a $8,200 check for the payments that you forewent.
Yeah.
And they're doing that. They're like, oh, okay, I have the money. Mm-hmm. Like, we just took a break. We didn't know what was going on. We just saw it as a thing. So a lot of the forbearance periods are ending and they're either working the forbearance into the back end of the loan and now which means adding it to your principal. And now we're back on track making our payments. And so a lot of people are coming out of that successfully, and that's going right along with lower unemployment claims. We looked at non-farm payrolls, which is the labor department's big economic, like what are jobs doing number, and that blew expectations out of the water last week.
Yeah.
So now you're seeing people come out of forbearance, and you're seeing that these that people are picking up on making their payments. Now,
maybe we should see if Chelsea wants to be on our podcast live. Should we?
You want to answer a phone call?
Let me see. Let's see. This will be fun for the show.
Yeah, let's do it.
Okay. Chelsea, this is Brandon. How are you?
Hey, I'm good. How are you doing?
Doing well. You are on a live podcast right now, and so we thought that we would call and say hi. And you're on a live show. You're on a live stream right now, so say hi.
Hi. I don't know if I believe you, but
well, you're going to find out very soon when it comes out.
This is a podcast about horoscopes, though.
Yeah, so we're talking about that. We're talking about the February housing market. So if you're cool with it, we can call you back in just a minute.
fine.
All right, bye. Oh, that's great.
I like that.
That was one of our reps at one of our lenders.
Yeah.
Yeah.
So Chelsea's great.
Yeah.
But back to that though. But we're still seeing like your FHA and
That's
your
what I love
VA
about
loans.
this show, by the way.
Oh, the weird stuff.
This is entertaining.
Yeah.
I mean,
I do like that.
Yeah.
I get all into the nerd stuff
Yeah.
now, and I'm like, finally somebody cares because my wife and kids are like, really, Dad?
Yeah, I know, right?
Like we care.
Yeah.
So, but nonetheless, we're still seeing a lot of delinquency in that FHA and in some of that VA world, but those loans also have a lot lower qualifying requirements too. So they're going to be a lot more apt to be in default.
Yeah.
Right? That's where some of your subprime borrowers are going to end up, especially in the FHA world. Maybe not VA is kind of like hit or miss, but it gets lumped in with the government.
What's
loans.
the average number of mortgage delinquencies in like a healthy mortgage market? Do you know the numbers?
Not off the top of my head.
I think it's about 1 million.
Yeah.
So that's why everyone was freaking out when it was 3 million. But at any given time, in a good economy, I think there's about 1 million people that are delinquent on a mortgage at any given time.
Yeah.
And so now we're hovering at 2 million instead of 3 million. It'll be interesting. Let's just stay close to that as we keep moving forward throughout the year of 2021.
For sure.
So all right. So rates they're up slightly. Let's talk about the housing market. So the first thing I want to look at is the number of new listings. So we're going to compare February 2020 to February 2021. In 2021, 9,200 new listings came into the market as to compared to last month, 7,200, down 21%. So the story continues.
Is that the state of Michigan?
Yeah, this is the state of Michigan. Yeah,
Okay.
yeah. So
7,200 listings.
yes. So no, it's not that many. I mean, the story continues as far as lack of inventory, right?
Yeah.
So all the media people that are talking about, doom and gloom and the next housing crisis, market crash, all this stuff. I mean, as it relates to everything you just talked about and the first stat we're going to talk about today, I don't see it. So a lot less homes are coming into the marketplace.
Right.
We're down 20% from an inventory that's already diminished. And then in addition to that, home sales. This is the crazy part, right? So you got less homes coming into the market. The home sales, you would think, well, maybe home sales are down too. That's not the case. They're the same. So the same number of homes are selling. So a little over 7,000 homes hit the market. How many homes? How many homes hit the market? 7,200.
Right.
7,100 of them sold.
That's like no inventory.
No inventory.
Yeah.
So we're going to talk about something here in a minute called the absorption rate. So number of closed sales. So that was pending. Closed sales were 6,500. So that was the key. So number of transactions are up. Inventory is lower. I mean, I just don't see how the media keeps talking about housing crisis, doom and gloom. I mean, the numbers are right in front of us.
Right.
I mean, the facts are facts, taking the emotion out of it. You got unemployment getting better, right? Which is a sign that the economy is doing better. It's recovering from the pandemic. And you have the housing market that continues to sell more homes, and less homes are hitting the market, driving prices up yet again. So if you look at values, Steve, from last year to this year, they're up another 15%.
Right. I think the big, I mean, it's like economics and the news media, though. They're so stuck in what happened before.
Mm-hmm.
You know, they're like, this is going to be a headline. This is going to get clicks on our page. This is going to get people to watch our shows. And then the data, like the meat and potatoes of those arguments, is literally they're using like forbearance data where the government came out and said, as long as you say COVID-19 impacted your life, you can take a break from mortgage payments. From a mortgage perspective, it's literally never been more difficult to get a mortgage. I mean, if you're self-employed and you're not an expert in your own business and like wildly organized and really track all of your expenses and income really well, you do not get a loan. And if you do, it takes 12 weeks. It is a complete nightmare for a self-employed person. And for somebody who is working, I mean, the verification process and the qualifying for a loan has never been more strict.
Yeah.
And these numbers are rising. You know, so we're putting the buyers that we're putting in houses, we're not giving, you know, $500,000 homes to, I don't want to offend anybody, right?
Yeah.
But like, you're not giving it to people that can't afford that mortgage. Maybe somebody that's in a, you know, that's 19 years old working at a restaurant.
Yeah.
They're not getting that $400,000 mortgage. I mean, these are people qualified.
They're very
for
well
legitimate
qualified.
mortgages.
Yeah, what we're saying is we're not giving $500,000 loans to people that make $15 an hour anymore.
Right, exactly.
Yeah, you're giving them to people that actually qualify for the money. Mortgage guidelines are way tighter, and based on the stats, no emotion. The facts are the facts. I mean, coming out of coming out of February into March, things look stronger than they did before. So a couple more things. So average prices are up another 15%. The amount of time it's taking to sell homes is going down, right? Because lack of inventory, interest rates are low. That makes sense. Houses are selling a little over 30 days. Percent of list price received. So this is someone's lists a home at $100,000. How much of the 100,000 do they get? Well, last year it was about 96%. Right now it's just under 99%.
That's awesome.
I mean,
That's
they're getting
crazy.
what they're asking, right? So home prices continue to go up. All right, so let's talk about inventory for a second. This is the craziest thing. So if you look at, you know, the amount of homes for sale, or we call it months worth of supply, it's down 56%. We have just over 30 days worth of homes for sale. So if more people, it'll be interesting to see what happens in March, because if more people don't put their houses up for sale, which you can get a ridiculous price right now, you couldn't argue for a better time to sell than right now.
Yeah.
But if more people don't sell, I mean, there will be no houses for sale. Literally, there will be no houses for sale.
Yeah, it's crazy.
And so no one's ever seen a market like this. What do you think? It's like the chicken or the egg, you know, for the buyer, you're giving mortgages out at, 3%, let's call it.
Right.
But there's nothing for them to pick. And then we sit here on a show like this and say, okay, well, it's the best time to sell.
Right.
The people are like, well, Steve, Brandon, great. Where do you want me to go?
You can't even get a good RV right now.
Yeah.
Like the RV market's totally overwhelmed too.
Yeah.
You know, there's that's the biggest thing. I mean, we're even looking, just because I'm always looking at houses, right? Just what we do. And I'm like, man, I'd love to move. And I'm like, man, I have nowhere to go. You know? So like you've always said, the grand plan as you sell now and you sit on your money and you're like, well, that's cool. So we're going to look at the RV option, and now we're looking at like tent options. Like it's a crazy market. And I talked to somebody the other day and they're like, well, I don't want to overpay right now. Like, I feel like if I buy right now, I'm overpaying and I'm going to end up with way more of an expensive house. And something that I look at, so the current average sale price of them is like $30,000 more, right?
Yeah.
the average sale price is $200,000. It's gone up 30%, or
Right.
say 15%.
Yeah.
It's $30,000.
Yep.
Right? Is my math right? Yeah.
Yeah.
So if you're looking at the difference in monthly payment, though, so based on rates today at 3%, let's say a year ago at 4%,
Yeah.
the payment's literally $5 more today. So now you
Crazy.
have, nobody makes a mortgage payment and they're like, okay, so I'm going to pay this out to bank ABC. Payment's $1,011. My home is worth $250,000. Like nobody writes what their home is worth or what they're paid on their check. Like
It's all
you're making
relative.
the same payment, right?
That's
so
right.
That's what's really fueling this fire. So now you can get into that $300,000 home that before was like $250,000, and your payment's going to be the same. It's probably the same house. You're like it's
That's a
all
good point.
working together.
It's all
you know?
relative.
Yeah, it's kind of it's a weird thing.
I mean, if anybody's worried about that, that's where I come up with that strategy. I've been talking about this on our market update shows for a long time. Well, then sell and rent.
Right.
If you're worried about buying at the height, well, you can't have your cake and eat it too.
Yeah.
Because every seller I talk to today says, well, I want an absolute premium for my house. I want people, Brandon, to overbid, overpay for my house. But then when I ask them, are you prepared to do that to buy a house? It's absolutely not a chance. So if that's your position, great. I'm not mad at you. Then you need to sell and go rent somewhere until the market comes back down. But to your point, with interest rates being so low, what you're saying is a house today, the average price here in Metro Detroit's $250. It was $210. You get the same house, the payment's arguably the same.
The same, exactly.
I mean, it's crazy. So we'll see what happens in March.
Where do people go though? If they want to rent. I mean, they're literally the only place you could rent right now would be like an off-season Halloween USA. Like you'd literally have to rent you'd have to rent in a strip mall. It's
Honestly,
like the only place.
I'll tell you. So
vacancy.
I've got some friends in South Florida who took me up on this advice, and they're literally in a luxury hotel. So they've got a doorman, they've got someone that washes their car. They went to a hotel because they don't want to sign a long-term contract either, right?
Yeah.
Long-term lease.
Yeah.
So there's options. I mean, how practical is it? Not very practical, right?
Right.
People with kids, in your situation or my situation, it's hard to do. But I'm just saying, for the folks that are so bent out of shape to not want to overpay,
there's an option.
There's an option for that, So it'll be really interesting to see what happens in March, and we'll do this again in 30 days.
Yeah.
What's your prediction in March as it relates to interest rates?
I think we'll see the pressure continue to go up.
Yeah.
I think we'll probably see a little bit more. Like I said, the non-farm payrolls came out last Friday. We have stimulus coming out. So they're really going to want to see where this goes and how sustainable it is.
Yeah.
Like I said, good news is bad energy for interest rates, right? So now we've got like another vaccine. We've got a possible therapeutic drug that's supposed to be amazing that is testing and should be done testing in the next month. I mean, I think we'll continue to see some increase in rates, but I think it'll probably be very slow. Then nobody wants any of that to go fast because that'll mess everybody up.
Yeah.
And hopefully that shakes the cage enough.
Yeah.
To get some houses to move, whether it be to sell some homes or, you know what I mean, to get some houses on the market.
Yeah, and that's where, all of that, I think is going to help people feel better about moving. Because I think the other thing we didn't talk about is like people feel unsafe from the pandemic, not wanting to show their property and open their houses up. So now that we're coming back into spring, this thing's been going on for a year now. I think people are more comfortable, more confident.
Yeah.
And so my prediction from a housing perspective is that you see March, April, May, a big spring market of new listings entering the marketplace.
Yeah.
It could be a historic spring as it relates to real estate.
Yeah, I don't disagree.
Transactions, new homes hitting the market. So we'll see. So the next time we do this show, it'll be really interesting to report the numbers. And so we'll have to wait and see.
And I don't think rates are going to impact it that much.
No,
I think there's a lot of there's an index out there, the consumer confidence.
Yep.
Is a big index we watch, and that's growing. Like people are getting more and more comfortable, and I think maybe you were scared to sell or buy, or because of the pandemic, or you didn't like people in your home. I don't think I think once people make up their mind that they want to move, and you really realize that after you've been in your house for 12 months, like literally in your house, in your backyard, and around your neighbors that maybe you like, or maybe you realize you really don't. Mm-hmm. Like that mind is made up. And I think those people are going to be like, okay, we're moving.
Here's the interesting, I want to end with this today, is the interesting thing that I think is going to happen for the first time ever is now that you have massive employers sending people home to work at home permanently, these people are relocating. Yeah. Different states, different parts of the world.
Yeah.
And that brings a whole new segment of the marketplace that's never been there ever.
Yeah.
Ever, ever, ever. And so that you ask where do listings come from, potentially from that segment of the marketplace where they live in a Metro Detroit and they've got a second home in Florida. Well, they can make that move permanently now that their employer says, well, you can work home virtually full time.
We're seeing people move 30 miles from work now. They're like, I've been to live in, this Royal Oak area or Ferndale where it's very congested. And they're like, hey, I'm moving out to the burbs now, baby.
Great point.
We're getting out of town.
So there's a whole new segment of the marketplace that this spring and summer it'll be interesting to see what happens.
Yeah, for sure.